Welcome to a new video, and today, as you can see from title, we are going to discuss what are the risks that you run into when you do a PMCC, right? It's poor man covered call, and what you can do to mitigate those risks, right? So that's gonna be the core focus of today's video. If you are into a situation where your PMCC calls are in loss and you wanna know how you can mitigate those things, then this video is for you. Stick around and we are gonna discuss all about that. Hello guys, so PMCC, right? If you don't know or completely do not understand how to open a PMCC call, then I have a detailed video. I definitely would suggest that you watch that video because I'm not going to go much detail about how you can open a PMCC call. I'm just gonna be focused today on the risks and what you can do to mitigate those risks, right? So PMCC, just a very quick overview what a PMCC is. So that's basically, as the name suggests, right? It's poor man covered call. That means it's a form of covered call where you require a much less capital than owning completely the 100 shares, right? So let's say for a traditional covered call, right, you will have to own 100 shares of a stock and then you sell covered call on that, right? Compared to that, in PMCC, what you do is you buy a very long dated leap option, which is deep in the money. Almost that's gonna be synonym to owning the 100 shares of a stock, right? However, you are putting much less capital because ultimately that's an option. But this gives you the right to sell calls against that, right? So that's why the name is poor man covered call. Again, watch my detailed video. That's gonna give you how to execute that in Robinhood platform or any other platform or brokerage that you use, right? Okay, now coming to the core topic, right? The risks of PMCC. So let's first discuss the risks and then we will go to how you can mitigate, right? So the risks. So risks are pretty much same as what you would actually encountered in a traditional covered call, right? So the number one risk that you have is of your shares getting called away. But since in this case you do not have any shares, you risk the assignment of that call option, right? Most of the brokerages will try to close if your position is in a losing state, they will force close your position. So that's the risk that you take, right? So let's say you have a position open and that's gonna be you think that's the stock underlying stock has kind of overshooted your strike price, you will be in a loss, and then your that position will get closed and your underlying the leap option, right, that will still be in profit. However, we don't know what will happen over the weekend and you run that risk of when the market opens Monday, you may be on a losing position for that leap option, right? So that's the biggest risk that you have when you do PMCC because it's a contract position. It's not like a stock that you have. So you risk that theta working against you. And if you keep holding that over the weekend, there is a chance that you may be in a losing position to open another covered call against that position. Okay, so I'm going to discuss, if that sounds a little bit confusing, just hold on. We are going to discuss all this. I'm going to show you exactly what the risk is. And when you see that in a platform, like I use Robinhood, it will make more sense of whatever I spoke just now, right? So just hold on for a bit. And then at the end of this video, we are going to be, I'm going to show you everything in detail in my Robinhood platform. Okay, so that's about the risk. Now, how you can actually mitigate that risk, right? So there are a couple of ways how you can do it. First of all, what you can do before that, right? So whenever you open a covered call against your PMCC, the one thing that you need to definitely do homework on the resistance, right, of that stock. So you have to watch out. I have a video about a little bit of technical analysis that you can do. I will put that link. So the one thing that you need to do is you need to watch out for the resistance, right, where the stock is over the at least last couple of if you are doing covered call monthly, then take a 3 month window. If you are doing a weekly covered call, then at least take a month, right? So in the last month, look at where the resistance is, right? Or expand that to 3 months. Look at where the long-term resistance that the stock has. Definitely make sure when you open a poor man covered call, the call position, the short leg, right? Definitely make sure that your strike price is above that resistance, right? Because if it is below that resistance, you are again running into the same situation what you run into against in a traditional covered call, right? So that's the one thing to mitigate the risk. Do your homework properly before you select the strike price of your short call. Okay. Now the second thing is about the rolling over, right? So I think it would make more sense if I show you directly in the platform rather than explaining it here, because that's gonna make it more sense. It's just rolling it out as you do in traditional call, but there's some nuances here because against the stock you have some benefits if you own the stock. So we're gonna discuss that. So let's move on to the last part of this video, which is showing you exactly how you can do this thing in the Robinhood platform. Okay, guys, so I'm in my Robinhood platform, right? As you can see, I'm going to take this Intel example because this is one position that I have as a poor man covered call, which I'm doing right now. So that will make very good sense, and I can exactly show you the things that we spoke about in this video, right? So this is a Intel call. As you know, Intel has recently kind of broken out of the long year, more than multi-year resistance level, right? So now it's in a different level that it's trying to touch. If you look at the Intel, let's look at the 5 year, right? So if you look at the 5 year, if you look at this, right? So this is like a very long, between 25 to 30, it has been always in that range. And now recently it is based on their acquisition or the investment from Nvidia, they are kind of breaking out here, right? So that's why there's a lot of potential now that it has broken out of that long range. So that's why I've decided to open this as a PMCC, and I just wanted to keep my exposure a bit less. So I've just opened one contract. So this is the call, right? The long call that I was talking about. So in this case, I have this Intel, which is I have expiry as 2026, right? Which is almost maybe 9 months out, right? And then against that, it's not too deep in the money. So that's one thing that I do want to mention, that ideally, if you wanna do this in a more maybe more deep in the money. I have just kept it as 35 because I'm not gonna hold it for too long. I'm just taking the ride on the market that we have now. Everything is kind of in a bullish trend, so I'm just gonna take that ride to the trend, and then I'm just gonna close this out. But if you really wanna take multiple short calls over the maybe 6 months period, then it's better to go more deep in the money, so you have more intrinsic value attached to it, which you can take advantage of, right? So this is the INTC call, and let's talk about the one thing that we talked about, the risk, right? So this is the call that I have for next week. Okay, so in this call, if you see right now, I am in profit, and my average credit was $97, right? But there is a risk that I will run into if Intel crosses this $41. Okay, so right now it's at in 39, but if it crosses that 41, then I will be at a little bit of risk there, right? So that's the risk part of it, which I was explaining, right? It's same as a traditional call. You run into the risk of the mm, stock price shooting above your strike price, right? So that's the same risk that you run into for that. Now coming to the mitigation part, right? So for that, you do little bit of that technical analysis. Look at the 3 months chart. If you see here, right, this is the kind of good support, and this is the resistance that it's trying to do. Okay, here. So Robinhood, we use the Robinhood Legend, I would say, not this view. I have some videos about Robinhood Legend because that's a better platform to do the charting. So definitely use that, not this one, because it doesn't go into detail thick, right, that you see here. It's just the lines, and it's not a very good charting platform. Robinhood Legend is a much better platform, I would say, for these identifying these short-term or long-term resistance that you see here. So use the Robinhood Legend, watch my videos. I've explained how to set up, how to configure Robinhood Legend overall. So use that. Now, coming back to this thing, right? So if you look at here, right, if it crosses this, then I will be running into risk. So one thing is, put your strike price more above, right? If this is here, put it like maybe 45 or 42, right? So you reduce that risk. So that's the first thing. Now second one is the rolling out. Let's say it definitely moves from 41, it goes to like 42, right? Come, it's a November 7th expiry, right? So November 7th is gonna expire. Let's say on November 5th, I see that it looks like it's gonna close above 41, right? So I would have to start thinking about that. So for that, you take this, what you do is it shows the option, right? It says roll this position. So you roll this position, roll it out, right? So select that next expiry, right? You roll it out. So you can do maybe 1 week out, or you want to do, if you are really deep in that, if you're really deep in the money, and let's say it goes to 45, then you will be in the money a lot. So you may have to move this expiration date further, right? To account for that, the intrinsic in the money that you have now. So use that, try to be still in credit, right? In this case, so let's say I move 20 days out, you go out, right? So you basically select more above here, right? So you select 45 here. Okay, so that's, you see, right, I'm still in credit here. So that's how you do continue, and then your next thing would be like $45 call, which is Intel. We don't know in this market, but looking at the previous thing with the Intel, there is a slight, it's gonna kind of be in a consolidation phase, I feel, between that 38 to I think 40 to 44 kind of a range. It's gonna consolidate over next, I would say next couple of months. It's gonna just consolidate. So it has gone past that resistance, and now it's kind of in a resistance phase, right? So that's why I want to take advantage of that consolidation phase that we see right now. So this is how you do. You select this 45, and then you review order, and then you're gonna select this. So your estimated credit, if you see, right? So that's combining your previous one, because I was already in profit, but I'm just talking of a scenario where you go deep in the money and then you wanna cover. So you may see less here, but right now, since I'm already in profit in my current position, plus I'm adding 2 more weeks worth of premium, that's all accounted for this $300, right? So I can just do credit and then I submit it. So that's the roll out case, right? So that's the best thing, the way you can mitigate your PMCC call, right? Let's say coming November 21st, you are still in that losing position. You can again further move it out, right? And remember, you are in a losing position. That means your long call, right? Your long call is still gaining money, right? So that's a good part about PMCC, is your long call is still making you money, and you are kind of managing this until it kind of in a position where it closes below your strike price, right? So you just wait for that. No stock can just go forever, and that's the philosophy of the covered call. Stocks have to consolidate before it moves its legs further up or down. Okay, so down is fine because you're okay. Even consolidation phase is okay, and find a consolidation point where you think it's fine and just close out that position, right? And then wait for it to where you find a good resistance point, select your strike price above that, and sell your next short call. So that's how you run a successful poor man covered call. If you have any questions around this, definitely put your question down in the comment below. I will respond to them. For this video, again, I have a lot of videos in my channel about options trading. If you want to learn step by step, do follow those videos, subscribe to my channel. I will talk to you in my next video. Till then, happy investing. Bye bye.